Before we jump into the stocks, let's set the stage. The July 9th tariff deadline introduced new U.S. tariffs on imports, targeting key industries like technology, manufacturing, and consumer goods. These tariffs aim to protect domestic industries, but could raise costs and disrupt supply chains. Today, we'll explore 5 companies impacted by these changes, analyzing their fundamentals, market positioning, and why they're worth watching. To understand why these stocks matter, let's talk about the tariffs. On July 9, 2025, the U.S. implemented or expanded tariffs on imports, particularly from countries like China, affecting semiconductors, steel, consumer electronics, and more. These tariffs increase the cost of imported goods, which can benefit U.S.-based manufacturers but challenge companies reliant on global supply chains. For investors, this creates a mixed bag. Domestic companies with strong U.S. production could see a boost as imported goods become pricier. On the flip side, firms dependent on foreign manufacturing may face higher costs, squeezing margins. Our list today includes both winners and potential losers, so you can make informed decisions. Let's dive into our first stock. First up is Nucor Corporation, ticker NUE, a leading U.S. steel producer. With tariffs likely targeting imported steel, Nucor is a prime candidate to benefit. Let's break it down. Why Nucor? Nucor is one of America's largest steel manufacturers, known for its innovative electric arc furnace technology, which uses recycled scrap metal to produce steel efficiently. Unlike competitors reliant on imported raw materials, Nucor's operations are almost entirely domestic, shielding it from tariff-related cost hikes. If tariffs raise the price of imported steel, Nucor's products become more competitive, potentially increasing market share and revenue. Financial snapshot. As of Q2 2025, Nucor reported revenue of approximately $8.1 billion, down slightly year-over-year due to softer steel prices, but its EBITDA margin remains strong at around 18%. The company's balance sheet is solid, with a debt-to-equity ratio of just 0.3, giving it flexibility to invest in growth. Nucor also pays a dividend yielding about 1.5%, appealing to income-focused investors. Tariff impact. Higher tariffs on foreign steel could reduce competition from countries like China and Canada, which have faced U.S. tariffs in the past. In 2018, similar tariffs led to a 20% surge in Nucor's stock price over 6 months. While steel demand depends on construction and manufacturing, Nucor's low-cost production model positions it to capitalize on any tariff-driven price increases. Why watch Nucor? Nucor's stock is trading at around $150 as of early July 2025, with a forward P/E ratio of 12, suggesting it's reasonably valued compared to the S&P 500's average of 22. If tariffs boost domestic steel demand, Nucor could see upside to $180 or higher in the next 12 months, based on analyst targets. Keep an eye on steel price trends and construction data to gauge its momentum. Next, we have Apple Inc., ticker Apple, a tech behemoth that's feeling the heat from tariffs. Apple's a household name, but its global supply chain makes it a stock to watch closely. Why Apple? Apple designs iconic products like the iPhone and MacBook, but most of its manufacturing happens in China through partners like Foxconn. Tariffs on Chinese imports, especially electronics, could increase production costs, impacting Apple's famously high margins. Financial snapshot. Apple's Q2 2025 earnings showed revenue of $90.8 billion, up 4% year-over-year, driven by strong iPhone and services growth. Its gross margin sits at 46%, among the highest in tech, and it boasts $67 billion in cash. However, tariffs could force Apple to either absorb higher costs or pass them on to consumers, risking demand. Tariff impact. If tariffs raise component or assembly costs by 10 to 20%, Apple's margins could shrink by 1 to 2 percentage points, a significant hit for a company valued at over $3 trillion. Apple has been diversifying its supply chain, with plans to expand manufacturing in India and Vietnam, but China still accounts for 80% of iPhone production. In 2019, tariff threats led Apple to explore relocating 15 to 30% of production, and we're seeing that shift accelerate. Why watch Apple? Apple stock is trading at $220 with a forward P/E of 30, reflecting its premium valuation. Tariffs could pressure the stock short-term, but long-term investors might see dips as buying opportunities, especially if Apple accelerates supply chain diversification. Watch for updates on production shifts and consumer sentiment in Apple's next earnings call. Our third stock is Caterpillar Inc., ticker CAT, a global leader in construction and mining equipment. Tariffs could create both opportunities and challenges for this industrial giant. Why Caterpillar? Caterpillar manufactures heavy machinery used in construction, mining, and infrastructure, with significant U.S. operations. Tariffs protecting domestic manufacturing could boost demand for its equipment if infrastructure spending rises. However, Caterpillar also relies on global markets, and retaliatory tariffs could hurt. Financial snapshot. In Q1 2025, Caterpillar reported $15.8 billion in revenue, flat year-over-year, with a 13% operating margin. Its free cash flow of $2 billion supports a 2% dividend yield and share buybacks. The company's diversified portfolio, spanning construction, energy, and transportation, provides resilience. Tariff impact. Domestic tariffs could drive U.S. infrastructure projects, benefiting Caterpillar's excavators and bulldozers. The 2018 tariffs increased demand for U.S.-made equipment, lifting CAT stock by 15% in 6 months. However, Caterpillar sources components globally, and higher import costs could raise production expenses. Retaliatory tariffs from China, a key market, could also reduce sales, as seen in 2019 when China's tariffs hit Caterpillar's exports. Why watch Caterpillar? Caterpillar's stock trades at $330 with a forward P/E of 15, below the market average. If tariffs spur domestic construction, CAT could climb to $400, but trade wars could cap gains. Track global demand and Caterpillar's cost management strategies. Number 4 is Walmart Inc., ticker Walmart, the world's largest retailer. Tariffs on consumer goods make Walmart a critical stock to watch. Why Walmart? Walmart sells everything from electronics to clothing, with a significant portion sourced from China. Tariffs could raise costs for imported goods, impacting pricing and margins. However, Walmart's scale and logistics prowess give it an edge. Financial snapshot. Walmart's Q1 2025 revenue was $161 billion, up 6%, driven by e-commerce and grocery sales. Its operating margin is 4.1%, thin but stable for retail. With $9 billion in cash and a 1.2% dividend yield, Walmart is financially robust. Tariff impact. Tariffs on Chinese goods could increase Walmart's costs by 5 to 10%, especially for electronics and apparel. In 2018, Walmart absorbed some tariff costs but passed others to consumers, raising prices by 2 to 3% on affected goods. Its private label brands and U.S. sourcing initiatives, like its $350 billion domestic manufacturing pledge, could mitigate impacts. Walmart's e-commerce growth, now 20% of sales, also diversifies revenue. Why watch Walmart? At $70 per share and a forward P/E of 28, Walmart is fairly valued. Tariffs could create short-term volatility, but its scale and adaptability make it a solid long-term bet. Watch for pricing strategy updates and e-commerce performance in its next earnings. Finally, we have Advanced Micro Devices, ticker AMD, a leader in semiconductors. With tariffs targeting tech components, AMD is a stock to watch. Why AMD? AMD designs high-performance chips for PCs, gaming, and data centers, competing with NVIDIA and Intel. While AMD outsources manufacturing to Taiwan's TSMC, tariffs on Chinese components could disrupt its supply chain. However, AMD's focus on AI and cloud computing positions it for growth. Financial snapshot. AMD's Q2 2025 revenue was $5.8 billion, up 9%, with data center sales soaring 30%. Its gross margin is 50%, reflecting strong pricing power. With $6 billion in cash and a debt-to-equity ratio of 0.1, AMD is financially sound. Tariff impact. Tariffs on Chinese semiconductors or components could raise costs for AMD's supply chain, as TSMC sources some materials from China. However, AMD's chips are critical for AI, a sector less sensitive to price hikes. The U.S. CHIPS Act, providing $52 billion in subsidies, could also benefit AMD's domestic expansion plans. Why watch AMD? AMD trades at $170 with a forward PE of 40, reflecting high growth expectations. Tariffs could cause short-term dips, but AMD's AI exposure makes it a long-term winner. Monitor TSMC's production updates and AMD's AI revenue growth. There you have it, the top 5 stocks to watch after the July 9th tariff deadline. Nucor, Apple, Caterpillar, Walmart, and AMD. Each faces unique opportunities and risks as tariffs reshape the market. Nucor and Caterpillar could benefit from domestic manufacturing, while Apple, Walmart, and AMD navigate supply chain challenges. Before you invest, do your own research and consider your risk tolerance. Tariffs are just one piece of the puzzle. Watch macroeconomic trends, earnings reports, and trade policy updates. What do you think of these picks? Drop your thoughts in the comments below, and let me know which stocks you're watching.